Well, gold inched higher this week as equities investors took some profits off the table. Welcome to Goldseek.com radio, everyone. Your host, Chris Walczek, back with you for another big show this weekend. You may have heard the saying, sell in May and walk away. Investors seem to be following the adage so far this month. So who better to have on the show than two prognosticators of doom? Guest Harry S. Dent Jr. says that not only should investors sell in May, but be prepared for a credit crisis part 2. According to his demographic work, the stock market rally must fade, trillions of dollars must be delivered, and virtually every asset class will collapse. You'll want to stay tuned to find out what he's suggesting investors buy instead of the typical portfolio. But before that happens, he says gold will rocket higher, maybe above $15.25 an ounce. Next, trends doomsayer Gerald Celente is not selling any of his gold. He's preparing for total socioeconomic chaos as the economy implodes. So will tempers flare. You'll want to stay tuned for his always energetic and insightful comments. Then Robert Ian wraps up the show with another big report. And don't forget to call him with your questions and comments. We have a toll-free hotline for you, 1-800-507-6531. I hope you'll jot this number down on a Post-it pad or plug it right into your cell phone or home phone, 800-507-6531, 7 days a week, 24 hours a day. You can leave your comments. Well, the show begins now with the Market Weatherman Report. Mostly sunny skies appeared over the markets this week. Gold and silver rallied early on amid record global demand and domestic unemployment figures. But the rally fizzled as investors reached a stalemate regarding the U.S. Fed's next stimulus move. The threat of an end of QE continues to loom over the markets. Nevertheless, the precious metals did finish near the break-even point as the closing bell rang out on Friday. The New York COMEX exchange picked up a few dollars, finishing at $13.88 an ounce. Silver gave back last week's gains, ending at $22.27, still almost $2 above last week's lows. At a recent meeting, Fed Chairman Ben Bernanke noted that the central bank would maintain the $85 billion monthly debt purchases, including mortgage-backed securities and treasuries, only amid sustained signs of economic improvement. One of Dr. Bernanke's key targets is unemployment, which he's publicly stated must fall below 6.5% before giving up on stimulus. That's about 1% below the current level. Gold ran to a new weekly high point on news that U.S. initial jobs claims climbed 10,000 to 354,000. That was worse than anticipated by most economists. Other important economic factors, a solid GDP figure around 2.4%. A Friday reading from the Chicago Purchasing Managers Index showed the best reading in more than a year, topping expectations. And the Michigan Thomson Reuters Consumer Sentiment Index jumped to a final May reading of 84.5. That's well beyond expectations. So it's clear why investors capped the precious metals rally. Strong economic numbers suggest that the nascent recovery is in full gear. But then there's always that stubborn unemployment figure to contend with. Elsewhere, the recent price slide continues to be used by consumers to accumulate bullion worldwide. Demand from value-conscious investors continues to soar. Asian demand is red hot. Premiums are climbing sharply amid supply shortages. Record volume on the gold exchange was also seen this week, averaging 24.1 million ounces a day, while silver volumes surged 25%, about 165 million ounces a day, up from 132 million ounces in March. That's according to the London Bullion Management Association, the LBMA. The volume at the Shanghai Gold Exchange surged on its primary contract. In 2 days, the volumes have nearly doubled. Record demand for bullion coins and silver continues to keep the prices of both gold and silver well off the monthly lows. Physical gold demand is also solid in Singapore, where premiums are reportedly at record highs. In related news, currency volatility continues to ratchet up. Gold held up amid this week's collapse of the South African rand by nearly 8%. Plus, the U.S. dollar recorded its second consecutive lower close, adding support under the metal. As we've been reporting for months, the Commitment of Traders reports, or also known as the COT, continues to indicate short covering by the commercials and a loss of confidence by the weak hands, generally viewed as a positive contrarian indication. However, sentiment indicators should not be used in isolation for market timing, but are best used to increase investors' convictions. Bottom line on precious metals. Well, clearly 2013 so far has been the year of the equities market rally. Investors have rotated away from the commodities and into stocks. But signs that theme could be nearing an end are starting to show up in the global equities markets, particularly with Japan's Nikkei, which is rolling over sharply. Will this event, combined with favorable demand and COT figures, ignite an epic short squeeze? You'll want to log into your Alpha Stocks newsletter account this weekend. Moving on to the Wall Street Report, for the second week running, the New York Stock Exchange closed in the red as investors locked in profits amid a massive 17% equities market sell-off in the Tokyo Nikkei Exchange. The Dow Jones Industrials finished at 15,115, off about 187, down 1.2%. The S&P also fell about 19 points, over 1% for the week, finishing at 1630, while the tech-laden NASDAQ ended near the break-even point, 3455. George Soros, billionaire, investor extraordinaire, and author, sold shares of several financial firms, including J.P. Morgan Chase, Capital One, SunTrust, and Morgan Stanley, reducing exposure in AIG as well by 2/3. The financial superstar has pared his holdings of financial stocks by about 80%. That's a massive decline from his position of just 3 months ago, according to SEC figures. Turning to interesting stock candidates, last week's portfolio, American Pacific Corp., a chemical and aerospace company, continues to look appealing despite the index sluggishness. It's held up well. I think it actually moved or inched higher this week. Shares appear to be undervalued by about 100% given the DCF analysis, and that suggests an increase of 27 to 51 per share to reach fair valuation. In addition, another recent favorite appears to be carving out a bottom. That's Nexstar Broadcasting Group, NXST, undervalued by DCF analysis by about 300%. Shares are also holding up relatively well. They also carry a 2.2% annual dividend yield. Nexstar Broadcasting Group is a television broadcaster and digital media company. Now, as I've mentioned for the last couple of weeks, in the near term, the market is unwinding here the indexes from overbought conditions, so caveat emptor, buyer beware, at least for the time being. And as always, disclosure, I do not own shares, and I am not affiliated with these companies in any way. Just interesting stocks on my radar screen. Wall Street bottom line. Well, the Dow hit our consolidation target right on the button. Now that 15,500 has passed, investors seem to be locking in some profits, and which will likely set the stage for an important trading range. So once that range is carved out and well established, the next prognostication will be available to my Alpha Stocks subscribers. Coming up, Trends wizard Gerald Celente and the Dean of Demographics, Harry S. Dent Jr. More Goldseek.com radio headed your way at 64 kilobits per second. If you got the goods, they'll come in by it just to stay in the click. So don't delay, act now, supplies are running out. Allow if you're still alive, 6 to 8 years to arrive. And if you follow them, be out tomorrow. But if the authors shine, you might as well be walking on the sun. Okay, we're glad you're back with us here at Goldseek.com radio for another Gold Nugget segment. Today's special guest, Harry S. Dent Jr. from hsdent.com. Well, the Dow recently topped 15,500, a new all-time high. But before investors pop the champagne corks, they need to hear from my next guest, who says the Dow could drop to 3,300. Economist Harry S. Dent Jr., head of HS Dent Economic Research and Forecasting, editor of the free newsletter Survive and Prosper at harrydent.com. Welcome back, Harry S. Dent.
Nice to be back, Chris.
We hear of increased central bank spending, the EU and Japan leading the charge. The Fed's balance sheet is literally off the charts. Given these startling facts, could you outline why you think deflation and not inflation is inevitable?
again, the biggest evidence is very simple. Central banks around the world are fighting deflation. They are inflating at unprecedented rates, and Japan just went off the reservation here at 3 times the rate of stimulus that the U.S. has just done in late 2012. With QE3 and QE3 plus. They're fighting deflation. They're fighting debt deleveraging. We've had the greatest debt bubble in history. There's not even one close to this, going back to the Roaring 20s or the 1830s and other debt bubbles in history. And they're fighting deflation. They're inflating to prevent the economy from rolling over, from banks from going under, and for having debt deleverage. We need debt to deleverage. We have too much debt in our economy. We need it to deleverage, and the governments are preventing it. So it's bad policy, but in the short term, like any stimulus, like any drug, you take more of the drug and you don't come down off the high. And that's what governments are doing, and that's why investors need to protect their portfolios against deflation, not inflation, because when this stimulus fails, and I think it's likely to start to fail in the next year, like it did in 2012 in Europe, you're going to see deflation again, as we saw in late 2008. And in deflation, everything goes down. All financial assets, gold, silver, oil, commodities, stocks, real estate, they all go down.
Well, we certainly saw that in 2008, 2009. Virtually every asset class imploded, with maybe the exception of government bonds.
Yeah, government bonds and the U.S. dollar went up. Most people would have expected the U.S. dollar to go down. The U.S. dollar went up. We see the U.S. dollar as the safe haven more than gold. I actually like gold right now that it's plummeted. I think it's probably going to rally for several months, but I think even though it's a solid metal.
Okay, let's examine the credit crisis part 2 thesis you're throwing out here. What's going to stop our government officials from tearing a page right out of the playbook of the 2008-2009 John Paulson team, essentially another TARP program, couple of $1 trillion thrown into the system? What's going to stop Bernanke or whoever takes his place at the helm of the Fed? What's going to keep them from following in their predecessors' footsteps and essentially trying everything they can to reinflate the bubble as it implodes?
Well, they're already doing that, Chris. I mean, they're already reinflating the bubble. They're keeping the bubble going. As long as they keep the bubble going, as long as they keep stocks up and financial assets up, give banks money to cover their loan losses so they don't go under, and then the banks increase their reserves to cover those losses, and then the rest they invest at high leverage to make up for the fact that they're not making loans anymore. They're making money on speculation. This is not good that our banks are speculating in investment banks and hedge funds and stuff. So there's nothing to stop them. They're going to keep doing this until it simply fails. Monetary quantitative easing was meant to be a short-term solution to a liquidity crisis. It's not meant to be a way to fight a long-term demographic and debt bubble decline. And so they're trying to fight. They're trying to fight this debt bubble from deleveraging. They're trying to fight the economy from going down, which it needs to do. And the economy knows how to rebalance itself. I'm a free market capitalist. The economy knows how to rebalance itself just like our body does. If you get poisons, if you eat some bad sushi, the body will flush it out as fast as possible. That's what the economy tried to do in 2008, and the government says, no, we're not going to let that happen. We're not going to let banks fail. We're not going to let companies fail. They should have let the banks fail and maybe given some backstop and support on writing down loans. But we're increasing our debt instead of decreasing it after the greatest debt bubble in history. This is not good policy. It's not going to work out well in the end. So at some point, Chris, it just fails. Everybody that could refinance their mortgage has done it by now. Everybody now the home buying thing, they're saying homes are coming back. This is baloney. It's mostly speculators, hedge funds, individuals buying homes at discount prices below construction costs in many cases and looking to flip them or rent them out at positive cash flow. This is not a resurgence in housing by young families in the next generation just to get us at 2% growth, which is anemic compared to the 3 to 4% when baby boomers were spending money and we were in a boom from 1983 to 2007. This boom is over. It's not coming back, and demographic trends only get worse as we go ahead, and it gets extremely worse in Europe after 2013 or 14. The next 6-7 years is only going to be down, and government's going to be fighting more and more a declining economy with more and more stimulus, and at some point it's just going to fail. They're not going to stop. You're right. They will do everything they can to stop the economy from imploding, but at some point, like in 2012 with Europe, I mean, notice, Europe had $1.3 trillion in QE, LTRO they called it, and the economy fell into recession anyway, and it's still in recession, and it's still going deeper into recession because at some point the stimulus just doesn't work.
We have mortgage companies buying up the majority of the homes. There's no real growth. There's no actual consumer there. I mean, where are the families buying the family homes? You know, I find it ironic that it's incredibly difficult to get a loan right now or a mortgage at this time for the typical family, whereas in the peak they were literally handing out mortgages to virtually anyone. A bit of a dichotomy there, but I also wanted to ask you about how this Basel III Accord fits in with your work. You're talking about a credit crunch and write-offs. The BIS is attempting to tighten lending standards even further. Now, that does make sense from an economic perspective. Does that really make practical sense?
You know, when you have a boom that busts and things slow down, banks have to tighten lending standards. I mean, risks go up. And people keep telling me when I get on CNBC and all these interviews, oh, the stock market's undervalued. I'm like, we're at 16 times earnings, which is on the high side, which means there's a low-risk economy. We have the highest risk economy we've seen since the 1930s, with debt levels at extreme across countries, especially Japan and England and Ireland are the highest, and then the U.S. and Spain, outright depressions in southern Europe, you know, the Middle East going through this endless spring revolts, and they're not going very well. And China's got the biggest bubble in history. Commodity prices are falling, hurting emerging countries' exports. We've got a very high-risk economy, which would say, you know what, price-earnings ratios on stocks should be 6, 7, 8, 9, 10, not 14, 15, 16. The market is in la-la land, assuming the Fed's just going to keep stimulating, cover our backs, and it's going to all work out. It's not going to work out when demographic trends only get worse. And again, we fall off a cliff in Europe after 2013 or 14. I mean, Europe just falls as bad as Japan. And nobody's seeing that coming because nobody looks at demographics, and demographics are the greatest leading indicator, and economists don't look at it. They just think government policies, you know, the Fed can just steer the economy the way it wants to go. Well, they are short-term, but mark my words, in the next year or two, this stimulus is not going to work, and we're going to see another downturn, and at some point in the next 5 or 6 years, when demographic trends get really bad, we're going to see a crash that could take the Dow somewhere between 3,000 and 6,000. And you know, that's happened in Japan. Japan's been in a downturn for 23 years now, and every time the market goes up, it falls to new lows. So just to get to new lows, we'd have to get to 6,000 on the Dow, and I think that's likely to happen in the next couple of years. So investors need to say, hey, things have bubbled up. Thank you, government, for reigniting the stock market and all these things, but it's time to take your profits in the next several months and wait for the next crash, because I think there's another crash coming probably by 2014.
Okay, so the U.S. dollar is going to be one of the few safe havens amid this financial maelstrom. Yes.
I mean, it was in late 2008, the U.S. dollar versus our trading partners, the UUP, the dollar index and ETF, went up 27% when everything else went down. And like you say, the only things that went up were Treasury bonds. But even now, I think Treasury bonds may not do well because we've had a bond bubble and everybody's rushed into bonds, you know, for safety. And yields are already going up because the bond market's starting to anticipate that the Fed's going to have to stop buying its own bonds at some point. So, you know, the only real safe haven we see is the U.S. dollar, UUP, an ETF, and, you know, cash is good. If things go down, cash buys you more. So there's nothing wrong with getting nothing on your investment in T-bills. if everything's going to go down and you can buy stocks and beachfront property and Ferraris and everything on sale in the next crash. And, if you're aggressive, you short the stock market. I don't think the stock market is peaking here quite yet. We're not seeing signs of that, but I think this is the top before the top. I think, later in summer or early fall, we're going to see a top around 16,000 plus or minus on the Dow, and then another crash beginning. And so just, I think people should be selling off stocks. I think gold broke a key level at 1525. I was shocked at this. With Japan stimulating even harder than the U.S., gold fell, and I think because gold has finally realized that endless monetary stimulus does not create inflation in a deflationary environment of debt deleveraging around the world. So gold's been wounded, but I think gold's going to rally in the next several months, and then I would consider selling it. It may go to 1525 where it broke down. It may go higher, but I still think that the U.S. dollar is the best safe haven, and that's what everybody thinks is going to go down. Oh, the U.S. dollar is going to crash because we're printing money. Well, no, we're not printing as much money as Japan relatively, and we're not printing as much as Europe has already, and Europe's probably going to go another round pretty soon. So we'll see, but deflation is the end game, and deflation favors the U.S. dollar, and it favors cash and cash flow.
Okay, so you also talk about creative destruction, Schumpeter's economic term, where essentially a new economic order destroys the old, giving rise to prosperity. Are you expecting some type of deflationary reset of the capitalist system?
Yes, I am, Chris. And you know what? It's a really good thing. In the 1930s, we followed the bubble of the Roaring '20s, and we had a big crash. Debt went from 200% of GDP down to 60% because private debt deleveraged. We got rid of a lot of debt. Businesses consolidated, got much more efficient, and we came roaring out of that crisis. The Fed is preventing this deleveraging, preventing this reset, this deflationary reset. I mean, our economy grows and it slows over time. We have inflation, which ignites huge innovations in technologies, prices, and we have deflation that forces businesses to get far more efficient and brings in radical new innovations. We're in the next decade, we're going to see major innovations in energy and nanotechnology and biotech, robotics and things that are going to revolutionize our economy. But the Fed is stopping this downturn, stopping this reset, this rebalancing. Japan has done this, what we've done here, for 16 years. After the second crash in Japan, after 96, the government started doing QE. And all they've done is gotten a coma economy. There's been zero growth in Japan in GDP now for 16 years, zero inflation. What we should have had is a downturn and deflation, a reset of the economy, and we should have come roaring out of this. Japan's not coming roaring out of this. Even this recent rally in stocks is baloney. It's just the government saying we're going to stimulate and lower the yen and increase inflation. I'm telling you, they're not going to get to 2% inflation. You can't create much inflation. The U.S. is now at 1% inflation almost after unbelievable stimulus because the money's not being lent and spent. It's just being filtered into speculation, which means another bubble is going to burst. So this is very dangerous. And I think in the next year, we're going to start to see, if not see a major crash, start to see the beginnings of a major crash that's going to last for many years. And you'll be fine if you sit there like, deer in the headlights, just like in 2008.
In a congressional testimony last week, the U.S. Fed head, Dr. Ben Bernanke, noted that QE will remain in effect. I mean, he appears to be hinting that this sequester is hampering economic growth, and essentially Congress needs to step up and do something here. I mean, the Fed can't single-handedly hold up the entire economy on its own. He's also concerned about unemployment. Can you get into Dr. Bernanke's mind?
I can get into the doctor very quickly. He's never run a business. He knows nothing about the economy. I mean, nothing. He thinks it's a machine that you can just put in monetary stimulus and run at 4,000 RPMs and never take a break. Our economy is a dynamic, innovative process, an evolutionary process. The invisible hand from Adam Smith, way back in the late 1700s, that's our economy. It's an organic process. He thinks it's a machine. He doesn't understand anything about the economy. I don't care how smart he is, what he studied in history, he does not understand the economy, because if you don't run a business, you don't understand people, you don't understand what really drives our economy. And we look at demographics and what people do. And the baby boom generation was the biggest generation in history. You got to go back 250 years in the American Revolution to see a generation of this size that changes technology when they're young and creates a huge boom to follow. We haven't seen this, and now this boom is over. Baby boomers are aging. They're going to weigh on the economy with entitlements. The next generation is not as large, even though people say they are. They're not as large in numbers of births adjusted for immigration. We will never see a boom like this in most developed countries again, and the future is going to go to emerging countries, but they're going to be sunk by falling commodity prices and falling developed countries. So we have to deal with this downturn. We have to pay for the sins, whatever you call it, the debt bubble from 1983 to 2007. Debt grew at 2.7 times GDP for 25 years. How can you not have a hangover after that? And governments are saying, no, we won't have a hangover. We won't have a downturn. They're going to be wrong. They are preventing the economy from rebalancing itself, and it's going to have huge repercussions if we don't have a correction pretty soon. I think we're going to have a correction anyway. I think government stimulus is going to fail in the next few years, as it did in Europe in 2012. I think the U.S. is going to fall into recession by early 2014, if not earlier, and the whole thing's going to come down. And then the last card to fall is China, the biggest bubble ever. China has built cities, has built industrial capacity, infrastructures for nobody. They just keep building stuff, and if you look at China's stock market, it's been down since February of 2010. It barely had a bounce after a 70% correction in 2008. Because when you have excess capacity, it raises your cost, and your profits go down. So the stock market is saying China's economy sucks. And China's saying we're growing at 10%. First of all, I don't think they're growing at 10%. I deal with experts over there that say they're probably going at 4 to 5%. They're overstating. But China's got the biggest bubble in history, especially in real estate. And when real estate crashes, do you know that 10% of consumers in China control 60% of consumer spending, and these are the people that put all their money in real estate in these cities, Shanghai and Beijing and Shenzhen. When real estate collapses there, they are going to be hurting, and China's going to have a hard landing, and that's the last leg to fall off the table in this global bubble boom. So, again, I've been bullish since the late 80s with baby boom spending and demographics, but I'm saying now the trends point down in the next 6 to 7 years, and you better protect yourself. If you can preserve the wealth you built in real estate and investments and in gold and commodities and everything else, preserve it now, because it's likely to disappear as quick as it did in 2008, and probably more so.
From what I can gather here, I mean, you believe that the U.S. dollar, stockpiling real, solid, tangible goods, I mean, that would be about the only safe harbor for one's capital.
Yeah, basic things that people want. I mean, I always tell people, bourbon bottles, I don't know that we're going to go into social unrest, but it could happen. I mean, when I look at the extent of this debt bubble compared to the Roaring 20s and the 1870s and the 1820s and 30s bubbles before, things get very difficult. Unemployment goes up. Crime goes up. You have to, be realistic in all these areas and say, look, if this bubble does finally burst, and I think it has to burst at some point, and the government can't keep the bubble going past the point, then you got to say, look, yeah, I got to be defensive in my investments. I've got to be defensive in where I live. If I'm living on the outer edges of a city or in a smaller town, I'm better off than if I'm living in downtown New York or someplace that would be more vulnerable if things go bad. So you just have to say, look, I always say progress is exponential throughout all of history, and I've studied history so far back. Everybody thinks I don't have a girlfriend, but progress is exponential, but it's also cyclical. The bigger the boom, the bigger the bubble, the bigger the bust. So I'm expecting that we could have some pretty rough times. And all of our cycles, we have our demographic cycles and spending from the baby boom here and around the world, bottoms out around 2019 or 20. It doesn't turn up until 2023. And then in Southern Europe and many places, in Japan, it gets even worse. Our geopolitical cycle is positive every 18 years and negative every 18 years. Well, it's negative from 2001 to 2019. All of our cycles tend to bottom around 2019, 2020. And so between now and then, expect difficult times, and then if you preserve your capital and do the right things, you'll be able to buy everything at the bottom and benefit from the next global boom, which will be more in emerging countries like India, Southeast Asia. Mexico is kicking China today in manufacturing. Turkey in the Middle East is doing very, very well. There's a lot of countries that will do well coming out of this, but most of the developed world is going to have a tepid bounce because we don't have enough babies. We don't have enough young people to generate a boom like we saw from 1983 to 2007.
Could we see an increase in productivity, though, due to technology and something along those lines that could fuel a new economic revival?
Yeah, Chris, that's a great point. Nanotechnologies, making stuff out of nothing, biotech, re-engineering the human body, robotics, creating robotic machines that replace factory workers and young people, which, there's a dearth of young people in the world. As we're an aging society, we need more robots to take care of us and do things for us. There's huge innovations, alternative energy. Natural gas is a bridge to some breakthrough, I think, in the next decade. When we look at our cycles, we expect major innovations like the computer and the jet engine and radar and things like that in the 1930s and 40s that will advance our productivity. And that is the greatest hope, is developing countries. We're not having babies. We're not replacing ourselves. And the United States and Northern Europe is much better than a lot of other countries in Southern Europe and East Europe and Russia and et cetera. These technologies could give an advantage back to us in production and compete against the emerging world. But those things are not going to emerge until about a decade from now by our cycles. So, yes, technologies and aging societies, technology advances and productivity are everything because you no longer have demographic trends driving you up on automatic mode. So, yes, I do see that, Chris, but we'll have to wait and see how much these technologies increase our life expectancy and our productivity. But I think you're right. There is going to be another productivity revolution, and the question is, does it benefit developed countries more than emerging countries? And the truth is, such new technologies tend to favor the leading edge developing countries like the U.S. and Europe. So, but I think it'll be stronger for the U.S. than Europe. I think Europe is they've seen their greatest days, and we have not seen our greatest days, but we're maybe plateauing. But I think Europe, demographics are shrinking, and the more older people there are versus younger people, the less innovation. So I feel much better about the U.S. and Australia and New Zealand and Canada than I do about most of Europe. But yes, I think productivity is going to give us a boost, and that's going to be the only saving grace in a slowing demographic world.
Give you a chance to tell folks more about the free newsletter, Survive and Prosper, at harrydent.com.
We just teamed up with a marketing firm, and they said, what you do is called permission marketing, relationship marketing. You just give people free stuff until they fall in love with you or not. And so we now have a free newsletter. It comes out daily, from myself and my partner Rodney Johnson and our analyst Adam Odell. Every day we give a page and a half of what we're thinking about the current economy. We don't do as much forecasting and recommendations as we do in our paid newsletters, but it's a way to get to know us, and it's free. And I tell you, my mother finally told me, I like this newsletter, this free newsletter, better than your paid newsletter, because I can understand it and it comes in small bits. So yeah, it's free. You just go to harrydent.com and you sign up. No obligation. You just get it for free as long as you want. And if you like us, then you can trade up to our other newsletters. So I think it's a great thing. And I have to work twice as hard now to write this thing.
Harry S. Dent Jr., we want to thank you for your creative economic wizardry. It certainly is a very interesting and unique perspective that you have crafted here.
And I want to thank you, Chris. You're a great interviewer.
Hi, everyone. Chris Waltzek, your host of Goldseek.com radio. We all know how market volatility has made investing profits scarce these days. Every investor, even top hedge fund managers, seek input from others. The Alpha Stocks newsletter fills the financial information vacuum with just the facts that you need to improve your portfolio's bottom line. I filter through thousands of stocks each week to provide my subscribers with a list of high-quality stock candidates. Plus, there's the 5 top gold stock portfolio, which has consistently beaten the XAU index. The regular stock picks even top a well-known TV stock picker's choices. If you'd like to see where the Alpha Stock subscribers are putting their capital to work, please sign up at goldseek.com radio. You can try the service for 1 month if you'd like, or there's the more economical annual subscription. If you have any questions, you can reach me at my email address, gsr@hughes.net. Remember the Alpha Stocks newsletter for golden investment opportunities. Okay, we're so glad you've chosen Goldseek.com radio as a trusted source for business information. Today's special guest, Gerald Celente from the Trends Research Institute. Well, over the past few years, we've reported that half of the U.S. is at or near the poverty level. According to a new number released by the Census Bureau, that number could be approaching 75% of America. Joining me with his take on this and related current events, Gerald Celente, the director of Trends Research Institute. His team produces the TrendsJournal with hard-hitting, in-depth analysis on the economic, socio-political, and cultural trends. Welcome back, Gerald Celente.
Oh, thanks for having me back, Chris.
Well, clearly inflation is a big factor in this poverty level number. As the cost of everyday goods and services moves higher, wages never seem to keep up with expenses. What's your take here?
The gap between the rich and the poor in the United States is the widest of any of the industrialized nations.
What was that George Carlin saying? The 1% have all the money and make all the rules and do none of the work. The middle class do all the work and have virtually nothing. And the working classes, well, they're there to scare the middle class into going to work on Monday.
That's George Carlin for you. No, he was great. And as a matter of fact, his brother Patrick Carlin lives right up here not far from us, and he used to do some trends in the news features for us. But going back to the realities of what's going on, as we look at the data, let's make this 100% clear, and that is that not only is the gap between the rich and the poor the widest in the United States, but median household income is below 1999 levels. And then you look at the jobs that college grads are getting, and 50% of them are paying, the 50% of the jobs that they do have pay high school wages. And then you look at the other facts, and the fact is that the middle class was the ones that lost most of the jobs, that were middle class paying jobs, since the panic of '08 hit. And the fact is that the so-called jobs that are being created now are low-wage jobs. They're in the service sector, in the spheres of hospitality sector. You know what hospitality sector is? That's being a bartender or a waitress or making beds in a hotel, or the healthcare services. And unfortunately, healthcare aides, many of them, are getting paid less than minimum wage. And again, you look at the facts, you look at the data, American poverty is rising because the country as a whole is in decline.
500,000 relatively high-paying manufacturing jobs evaporating every year for over a decade. That amounts to 5 to 6 million manufacturing jobs. Those jobs aren't coming back, and neither are the benefits.
Well, you're right. And there's another element to that as well. Not only did we export the jobs, we exported the brains. Do you think that the Asians could have been developing and manufacturing the products that they are now if we didn't send the technology along with the jobs overseas? So not only did they sell us out on the work floor, they also rented out our brains for pennies on the dollar. And that's what's really killing our future. We've sold, again, the politicians have sold this nation out, and we're feeling the pain right now. And by the way, I've come up with a new term, that we term this country. It's Slavelandia. It's not America. What do you get? You get these kids that are graduating college now, all this news, college commencement speeches and on, as we're in that time of the year. And what kind of jobs are they going to get? They're going to work at Staples, where they're going to work at Home Goods or Home Depot. So it's a different kind of plantation economy, and that's what it's turned into. And the facts are there. I'm not saying this, making it up to be, a wise guy. I'm saying it because they've sold us out. Staples. Remember when there used to be stationery stores around the block? Remember when there used to be pharmacists that were run by the local community person, and now they get a job in Walgreens or Rite Aids? Remember when there were hardware stores before Home Depot and Lowe's took everything? Remember when there were retailers in your neighborhood that were dress shops and haberdashers before Macy's and Targets and Walmarts took all of the business?
There's a couple interesting statistics that I think people need to look into with regard to what you're referring to. Firstly, we have a government that's not supportive of the business that counts. The real jobs are the everyday mom and pop and entrepreneurs. We just hit 7% on self-employed in this country, and the lowest level in national history, and that was the former backbone of the United States. What we need is a government that supports small business.
And the Republicans and Democrats, they're bought and paid for by the special interests. I'm writing now about we're writing the Summer TrendsJournal. And I'm talking about a lot of this issue has to do with health and how terrible the health of the nation is. And recently, under pressure from lobbying groups such as the American Frozen Food Institute, that supplies school cafeterias with a lot of their product, Congress passed legislation declaring that eating pizza is the equivalent of eating vegetables.
Sure, 4 basic food groups there.
Yeah, everybody knows that. You know what the reasoning is? 2 ounces of tomato paste is the equivalent of a vegetable.
Of course.
Who can make this stuff up? I'll tell you who can make it up. People that are bought and paid for. So what you're saying is 100% right. It's a takeover. It's a corporate takeover. They don't care about us. They care about the people that fill their campaign coffers. We call it bribes and payoffs, where I grew up in the Bronx and Yonkers. They call it campaign contributions. So what we have here is a government of the big and the too big to fail. Who made that one up? This is supposed to be capitalism. Nobody's too big to fail, but now they're in control. Again. I have a headline in front of me from a recent end of May headline in the business section of the New York Times, the self-proclaimed paper of record, which I call the toilet paper of record. And here's the headline: Central banks act with a new boldness to revitalize economies. And they talk about the central banks from England to Japan, to the European Central Bank, to the USA, the Federal Reserve, about all the money that they're pumping into the systems, the trillions of dollars, to so-called revitalize the economies. Now, let me get this straight. They've been pulling this game off now since 2008. And that's 2009, 2010, 2011, 2012, 2013. It hasn't worked. Who has gotten this money? I'll tell you who's gotten the money. The banks. That's what's happened. The reason why gold prices, by the way, have not skyrocketed is because all of these banks are in cahoots. It's right here. They're all devaluing their currencies through so-called stimulus, which is really language for printing money that doesn't exist, and record low interest rates. So we're seeing the housing market in the United States, for example, housing prices went up 10.9% year to date. Why? Well, because you can get a home mortgage. I got one 15 years locked in at 2.85%. So the whole scam is going on, and they're all in it. So they're not going to do anything for the people. It's all about the banks. It's a banking takeover.
Great segue into my next thought here. I'd like your take on Basel III from the Bank of International Settlements. This is the world's leading central bank. It's a shadowy figure. They control 58 of the major central banks, including our Fed, but there's no oversight, no constraints of U.S. law. None of the members are elected by U.S. citizens, and yet we are under its domination. Some people are saying that the 2008 credit crisis was a direct result of the Basel II and 2.5 Accords, which put constraints on lending. Now, of course, lending constraints are important. We know this, but in a debt-based world, it causes major imbalances.
Well, my thoughts are, as the guy that coined the term, the Panic of 2008 in 2007, and I even took out the domain name, to me it was all very simple, and it began actually in 2002. And that was following 9/11, when the Federal Reserve began to lower interest rates to 46-year lows. People forget, Chris, that there was the dot-com bubble had burst in March of 2000. We were in a severe recession before 9/11. George Bush, they were ready to run him out of town before 9/11 happened. The economy was in a free fall. So what they've been doing, they pumped the markets up by these record low interest rates, and of course all of this other, no loans which showing nothing to back them up. They were giving them to anybody. No money down, no credit. So it was a big scheme. You remember it. Hey, you need an addition on the house? You want to go on a vacation? Take out a home equity loan. When I was a kid growing up, they called those second mortgages. So this is what's going on. So this to me, it was the death of the Glass-Steagall Act that made all of this happen. And again, follow the timeline. Glass-Steagall died at the end of 2000, at the end of Slick Willie Bill Clinton's term. And it allowed the banks to become investment banks. There was no barrier between them anymore. Investment banks, commercial banks. These are casinos that were gambling, and they gambled it away. All of these derivatives, remember these other things like synthetic collateralized debt obligations, auction rate securities. No, it was one big gambling scheme with no oversight. They put the Glass-Steagall Act into place in 1933 to prevent the banks from taking over and ruining the country. They destroyed the Glass-Steagall Act in 2000, and the banks went on to destroy not only America, but the rest of the world as well. Look what's going on in Europe.
You talk about the Glass-Steagall Act, and of course that essentially said we've got to separate investment banking from everyday banking, because when the two get together, we have a financial quagmire. And this time around, we had all these toxic derivatives, mostly tied up with mortgage-backed securities and structured investment vehicles and collateralized debt obligations, and throw your own 3-digit moniker in there. But I'd also like to stick with this Basel III Accord for just a few more moments. Some of these draconian policies could go into effect by the third quarter of this year. And I'm reading that this might trigger another credit crisis, sending the stock market plunging circa 2008, 2009. I'd like your comments.
Well, they're going to have to raise interest rates at some point. And banks are going to have some kind of margin in there that makes them real. They don't have it right now in most cases. This is an interest rate recovery, clear and simple. When interest rates go up and stimulus stops, the economy is going to go down. And again, there's nothing new about this. It's a bank, as I said, it's a banking takeover. Jesus Christ drove the money changers out of the temple. And what was that, 2,000 years ago? James Madison, 200 years ago, he said, quote, "History records that the money changers have used every form of abuse, intrigue, deceit, and violent means possible to maintain their control over governments by controlling money and its issuance." So that's all we have over here. But there are other wild cards, Chris, that have to be looked at. And that's the war drums are beating. And they're getting louder and louder in the Middle East. For all of those who loved Afghanistan, thought that Iraq was terrific, really were happy with what happened with Libya, you ain't seen nothing yet if they continue to make the war in Syria worse. This is going to ignite the entire Middle East. And it is going to be something that is going to spin out of control because, let's face it, America lost in Iraq. They lost in Afghanistan. They made a mess out of Libya. They're not going to pull this one off, and neither is NATO or the Arab Little League. So we're going to start seeing volatility that's going to expand far beyond the financial marketplace in terms of equities, in terms of finance, interest rates, etc. This is going to be much bigger than that. It's going to affect all of it.
If the Bank of International Settlements, the BIS, does take down the global economic system, what will take its place? Will we be looking at some type of historical money-backed system?
Well, as we know, the BRIC nations, Brazil, Russia, India, China, they're already talking about coming up with another reserve currency. And I believe there's going to be one. The dollar's not going to be it. The dollar may be part of it, and so may the yuan or the yen or even the euro. But I also believe gold is going to have a platinum place with the next reserve currency at some level or another. They're going to have to come up with something new because this whole thing is failing. As I said, I read that headline from the New York Times, Central Banks Act with a new boldness to revitalize economies. They're destabilizing they're destabilizing their nations by devaluing their currencies. So yes, there will be, I believe, a replacement, a new reserve currency, and a dramatic shift in banking over the next coming years as things get worse, when interest rates go up, when stimulus starts to slow down, the economies are going to decline rapidly.
You know, last week, the U.S. Fed Chairman, Dr. Bernanke, indicated no change in the massive stimulus efforts would come until economic activity starts to improve. You know, he's got his eyes firmly on unemployment, and we have seen those numbers coming back, about 7.5% at last check national unemployment rate. But I'd like your thoughts on whether or not he's bluffing, or will they actually pull the plug on QE and let interest rates rise?
They're going to have to pull the plug eventually. So that's the whole thing. And again, this is totally an interest rate recovery and a stimulus recovery. And again, they call it quantitative easing. Knowledgeable adults call it just printing money. They're going to have to stop this, and they're going to have to stop it worldwide. And when it stops, so too is the economy. It's going to decline. So it has to happen at some point. When will that point? And let's go back to the unemployment, by the way. Number one, the unemployment numbers are dropping because when people are no longer collecting unemployment benefits and have given up looking for jobs, in the USSA they call them nothing. They vanished. They're no longer called unemployed. So that's why the number is dropping. Number two, as I've mentioned, the jobs that have been created since the Panic of '08 hit have been low-paying, low-income jobs. So Bernanke could say all he wants about the unemployment levels, and the unemployment levels may drop. They may get back down, another full percentage point. But it's not going to mean anything in the real world. Because when you look in the real world, look at John Williams' shadow stats, and he's showing that the real unemployment level is really around 22%. And then again, we have to look globally. What is it in Spain? About 27%. What is it in Greece? About 28, 29%. What is Eurozone unemployment? It's over 12%. What's youth unemployment? Well, depending on the country you're talking about, it ranges from 60% to 35% around Europe. So when we're looking at what's going on, there's no way that the economies are going to rebound on their own. So the only way they can keep it going is by printing this money and by devaluing their currencies and by buying up bonds and treasuries and mortgage-backed securities, as the Eurozone is doing, as the Bank of Japan is doing, and as America is doing. Once these schemes stop, so too does the economy. But again, we may not be focused on the economy as wars spin out of control and they divert our attention into other life and death issues.
You know, once Japan started down this quantitative easing path, they never truly were able to pull the plug on it. And in fact, it's only been accelerating, with the Prime Minister Abe pointing to the Nikkei chart and saying, this is where we want to be. Sure, they can rattle the sword all they want to, but can they really pull the plug on QE?
They're going to have to at some point. And I believe the plug will be pulled when our attention is diverted toward wars. I mean, look what happened when that thing happened up in Boston. That's all the news was. The news wasn't about the economy. And the same thing's going to happen again. People's minds go off it very rapidly. So the economy could go into decline, and they'll blame those terrorists or something else for it. They'll never blame the policies. And you're talking about Abe in Japan. I mean, look at the hit that the Nikkei has been taking. Down 7.3 one day, down 2%, 3% another day. And you look at the Asian markets, they're all going down, 1, 2, 2.5, 3% lately. So the only way, and they're going down also because of the fear that the Federal Reserve may stop and may start to edge up interest rates and lower the amount of treasuries and auction and mortgage-backed securities that they're buying.
Well, I'd like to move on to demand for bullion. You know, it's red hot lately. Some sources showing 10 to 1 for every sale. That's about 1,000%, and that's all occurring since the sell-off. You know, the U.S. Mint showing 209,000 ounces sold last month. That's about 3 times the typical number. So it appears as though this assault on the precious metals market might be backfiring.
Well, it is backfiring to an extent, particularly as you point out on the physical level. And you know, I began buying gold in 1978. Having said that, I also bought at the highest point in the trading day in 1980 at 875. On January 20th, I believe it was. So I remember the panic that hit the air when the gold market deflated back then. It's a different world now. Back in 1980, there was no Russia. It was the Soviet Union. Everything east of Berlin was locked behind the Iron Curtain. China, the only thing you knew about China was Mao. India, you know, was some place where gurus went and Gandhi came from. There was no business going on. There was no global economy. And you look at the numbers, and you're talking about gold and the hard assets being bought up. Look around the world. Countries like Kazakhstan or Kyrgyzstan, whichever stand, they're buying up, you know, in record levels. So, and the other thing I also believe is that not only are the central banks behind the devaluation of gold on the paper markets, because why would anybody want to hold paper that's being, you know, printed at these levels that they're printing it at when it's going to be worthless? So I believe the central banks are behind it. But there's another reason, I believe, and that is Iran. You know, Iran's been frozen out of the banking system because of all of these sanctions. So they're selling oil. They're selling oil for gold. They're selling oil for gold to Turkey. They're selling oil to gold to India. They're selling oil for gold to China. And they want to see, you know, the Western powers are very much opposed to Iran. So the lower price goes for gold, the harder it is for Iran. So I think that's another possible factor. I'm not positive, but I think it's something worth looking at and thinking about.
China was not allowed to transact with Iran, and the way they got around that, the way they usurped those sanctions, was by allowing gold to be exchanged for oil. So you're exactly right. And some people have suggested that then once Iran received that gold, they had no choice but to dump it on the market. And so this was actually an indirect way for the Western world to try to knock down the precious metals market. But of course, it's going to backfire because the smarter heads will prevail and accumulate all of that bullion.
Yeah, well, again, you know, I'm in gold for the long. Again, I don't give financial advice. I'm in gold for the long haul. And as I said, I remember what it was back in 1980. This is a very different market. Again, back then, only the United States, some of Europe and Japan were really the players. Look, the Hunt brothers from Texas, you know, they cornered the silver market. You can't do that today. You know, the markets are so big, you know, and they're global. So yes, I believe these are temporary moves. They may drive down the price further, and it could last for another year or two. But at some point, it's all going to backfire, particularly as the war drums beat louder, gold prices are going to go higher.
Gerald Celente, please tell folks what they can expect to find when they direct their browsers to your website and pick up a copy of the Trends Journal.
Well, it's TrendsJournal.com, TrendsJournal.com, and it's history before it happens. Guaranteed you won't read what we publish anywhere else. We see the future before just about anyone I know out there. And also, Chris, every day we have, from Monday through Friday, I do Trends in the News. If you want to see the real news and not the kiddie news that they have on the networks or the cable TV, you only get it from Trends in the News. It's the truth in trends.
Thanks so much for being on Goldseek.com radio.
Thanks for having me, Chris.
right, welcome back to Goldseek Radio. Well, up next, it's Robert Ian from Conquer Change. Hello, Robert.
Hey, Chris, this is Robert Ian with ConquerChange.com. The battle between paper gold and physical gold is unfolding right in front of our very eyes, at least for those with eyes that are willing to see and understand. Managed, artificial, and manipulated markets take time to become visible, obvious, and apparent. This is true regardless of whether the market is gold, housing, or something else. What are the consequences of a manipulated or managed market instead of a free market? For one, significantly delayed or even non-existent gratification. What if you were one of the tiny fraction of individuals who have understood the dynamics of gold and the dollar the past decade, yet your investments into the precious metals sector has been an unrewarded journey? The demographics of resource conferences still appears to be slanted towards those who are 50 and up. The gray hair crowd who still remembers the late 1970s and may in fact have benefited from it. But nearly 2 decades of manipulation in this sector has caused many to give up, and some to die off, never to reap the benefits of what a truly free market would have produced. The consequences of mismanaged paper markets doesn't just result in delayed gratification or lost capital. They can result in death. Human collateral damage to the financial crisis is a reality that most people and the media deny and disown on a regular basis. Why? Because the subject is just too painful to talk about openly for any period of time. An article on Forbes.com late last year reports on a Spanish woman who committed suicide as foreclosure agents walked into her apartment. Amaya Igana, a former municipal councilwoman for the Socialist Party, jumped to her death from a 6th-floor balcony as a legal team from the court walked into her apartment to foreclose on her. She was found alive, but paramedics had no chance of saving her life. The Internet is full of stories of people who called it quits when the consequences of the financial crisis became too personal and too much to bear. Suicide is called a permanent solution to a temporary situation. From the outside looking in, these situations can often look temporary. But to the individual who is suffocating on the inside and sees no way out, the situation can look permanent. As we approach what many listeners to this broadcast believe will be a dramatic decline in the living standards for most people the world over, be alert to those around you who may be suffering in silent desperation. Don't be afraid to discuss the subject with someone if you think it's warranted. If you're suffering, reach out and ask for help. Thomas Jefferson's warning is unfortunately coming to pass, where he said, "If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and the corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered." The issuing power should be taken from the banks and restored to the people to whom it properly belongs. The warning Jefferson issued is what we are living through right now. Many are waking up homeless on the continent their fathers conquered. It's happening globally. Be aware of that as you see the destruction and collateral damage unfold. Remember, the life you save could be your own or someone you care deeply about. Chris, on June 28th and 29th, I will be speaking at the first ever Liberty Mastermind Symposium in Dallas, Texas, along with Bill Murphy, Jay Taylor, Martin Armstrong, and a dozen others. You can get full details on my website, and until next time, this is Robert Ian with ConquerChange.com, reminding you to follow us on Twitter at ConquerChange. Thanks, Chris.
Thanks, Robert, for another excellent report. Well, on behalf of the entire Goldseek.com crew, including Chris Mullen and Peter Spina, I want to wish you a very safe and profitable week ahead. Until we talk again, thanks for listening.